The residential segment forms a major chunk in the Indian real estate market, which comprises about 66% of the market, and the commercial segment, which comprises office and retail, is come second with about 30% market share, of which organized retail is estimated to be around 4 to 5% of the market. So when we speak about organized retail, we can understand that earlier the basic difference between the organized retail and the old mom and pop stores is organized retail. The examples are basically the large format, departmental stores and the shopping malls, etc., where the investment is normally done by big listed companies and private equity players as well. So the market value of investment grade real estate in India under construction has increased at a phenomenal pace from about $70 billion at around 2006 to about $120 billion now, which is about around 5 to 6% of India's GDP. The residential real estate segment contributes most to the real estate demand. The strong desire of Indians to own a home drives this demand basically. Whereas commercial real estate contributes to 70% of the market value. The tier 1 cities, which includes cities like Mumbai, Bangalore, NCR, Delhi, etc., which contributes around 70% of the market value of commercial office space available in India. While tier 2 cities like Chennai, Pune, Hyderabad, and Kolkata contribute about 20% of the pie. Other investment grade developments in tier 3 cities contributes to about 10% of the pan-India market value being developed in India today. So we can understand that the market is very concentrated at present, which is mostly driven by the kind of infrastructure, the kind of facilities, and the government push available, and the demand, the urbanization rate which is there in these cities, which drives the demand for real estate in these cities basically. But as the the economy grows and the infrastructure develops, I think the demand in tier 2 and tier 3 cities is has a long way to go, and there's where the real demand lies basically, because the market has been saturated in cities like Mumbai, Delhi, Bangalore, etc. Now comparing to comparing India with other global real estate markets, if you just compare one parameter, which is mortgage debt to GDP, India is at about 9%, whereas in US this ratio is 80%. In UK it's 88%. Denmark is about 104%. But even if you look at the developing countries, other peer nations to India, China is at 20%, whereas other developing nations like are at in the range of 20 to 25%. So even if we choose the closest competitor, which is China, and we want to reach where China is at today, today's scenario, we'll be looking at doubling of the existing stock of housing loans before we even remotely get to a level of saturation versus China. And that process by itself would take almost a decade. So we can understand, from this analysis, we understand that there is a huge scope of development and huge scope of superlative performance, which we are able to see within India basically. So coming to real estate valuation, there are various methods. We'll just discuss key methodologies which are adopted or used for valuing a real estate property, maybe it's land or building or residential or commercial property. So the key broad approaches of valuing real estate is the sales comparison approach, the cost approach, and the income capitalization approach. The sales comparison approach normally utilizes prices paid in actual market transactions of similar properties to estimate the value of the site. Whereas the cost approach is based on the principle that an informed purchaser would pay no more than the cost to produce a substitute property with the same utility and facilities as the subject property. And income capitalization approach is based on income generating properties, and it relies on market data to establish current market values and expense levels to arrive at the expected net operating income from the property, which is further capitalized based on uh, the yield from that property. The market yield basically is based also on the research that is done in the vicinity. Now, how do we measure or estimate that there has been no vacant land sales in the vicinity? So we can't apply the sales comparison approach here or the cost approach, because if the land has been purchased long time back, say 10 or 20 years back, the cost approach doesn't apply to areas, and the solution is to select comparable improved sales and subtract the value of improvements. Okay, so which means essentially means we have to value commercial property or residential property in the vicinity, and just subtract the value of the development or the improvement that have been done on the property to arrive at the value of land itself.